Hello, I'm Adam Grimes, and this video blog on trend indicators and technical analysis first appeared on my blog, www.adamhgrimes.com. Go there for more. You also should follow me on Twitter at AdamHGrimes. So I want to take a few moments today and dig into a specific kind of trend indicator in technical analysis. And I really hope to accomplish two things. One, yes, we're going to look at this. We're going to look at some statistics. We're going to try to understand what is happening, how it works, how it maybe doesn't work, and why. So that's the first thing. The second thing, which I think is even more important, is I want to give you tools. I want to give you tools that you can do this kind of work yourself, that you can go to the market and ask questions. You don't have to take anybody else's opinions or ideas online for what might work. You can go find out. And this also will encourage you to be a little bit skeptical of some of the claims out there. So let me give you a little bit of history. A while ago, many years ago, actually, I was trading a system and it was working. I was making money with it. It had as a filter a trend indicator based on the slope of a moving average. And I decided, well, let's dig into the system. It had a lot of parts, and let's figure out what each part is contributing to the overall results. This started when I went through and started to look at that trend indicator to see what the statistics really were. And so let's back up just a second here and look at trend indicators in general. So I think there are, if we're looking at, and you see the price bars here, and the colors will change in a moment. So I know the colors aren't great. Bear with me, please. And I have a couple moving averages. And I will tell you, first of all, I just took the default parameters. I opened my software. I said put two moving averages on. It happened to be set to 9 and 18 period. If as we go through this, you find yourself asking, well, what would have happened if you used different periods of moving averages? Then I would suggest that you're probably at an early stage of this type of thinking. Because what we find doing this work is that the numbers, the inputs don't really matter. At the extremes, we see some kind of weird things, but anywhere in the middle, 5, 10, 50, 200, 300, doesn't really matter what period of moving average you're using. You're going to see similar things. And you don't have to take my word for it because you're going to be able to do that yourself. So I just have moving averages on the screen. Pretend for a moment, please, that there's just one moving average and ignore the green line. So we have the dark line, which is an 18 period moving average. One of the ways we can use a trend indicator, there are basically three things I think that people do to define trend with moving averages. One is just looking at the slope of the trend, and that's what I was doing. So as long as the moving average is sloping up, the market is trending up. Moving average slopes down, it's obviously trending down. And of course, with all of these trend indicators, we'll have some confusion in the middle where the market's flat, and you have to decide what to do with that. There are a number of ways you can set some bands and say as long as it's in a certain area, we're not going to have a trend, or you can take every little jiggle. Again, there's a trade-off, and you'll see the bottom line doesn't really matter much. So that's one, the slope of the moving average. The second thing people do is we can look at whether price is above or below a moving average. So here's a good example. Price is above the moving average, and we would say this is sloping up. And here price is below the moving average. Trending up. Price is below the moving average, so we're trending down. And this crossing of the moving average. And again, you can decide how you're going to do it. Are you going to take any penetration? You're going to require a close beyond a number, 2, 3 closes beyond, a close of a certain percentage beyond to flip. Will you have a neutral indication? There are a lot of possibilities. And I will tell you, I've tested hundreds and hundreds of these rules. And my conclusion is pretty much it's all the same. I'll get right to the punchline. It's all the same. It doesn't really work like we think it should. So we have the slope of the moving average, then we have price above and below the moving average. And then the third thing is to use two moving averages. And here I have a faster moving average. This is a 9-period moving average. The other I said is an 18-period moving average. And you'll see the faster moving average, the faster moving average, which has a shorter time window, will track price more closely. responds quicker to changes in prices because it's averaging fewer prices. It makes sense, right? And visually what we'll see is that these so-called fast moving averages will stick closer to the price. So then we can do things like if you have your slower moving average, when the fast moving average is above, we're in an uptrend, and when it crosses, we're in a downtrend. And you can see very clearly here. And this is what we're going to work with today. I'll come back to this in a minute, but I want to go ahead just a little bit. So you're flipping to a downtrend here, flipping to an uptrend here. There are a couple extensions of this that are possible. You can use more moving averages, and you can put a faster and a slower moving average and then do things like, let's say you have the 5, the 10, the 20, and the 50. You might say that you're only in an uptrend when your moving averages are stacked correctly, and you're only in a downtrend when they're flipped. And you will sometimes, you have confusion where the 10 will be above the 20, and then the 5 will be here, and the 50 is here. And what this is showing you is some type of confusion, and you wouldn't have a trend. You'd wait for this clarity. And I've tested that elsewhere. That's not what we're going to be doing today. Let's just work with this very simple 2 moving average cross. One more thing before we actually get into it. But underneath the price bars, I put the percent change for each bar. So that's what this histogram is. This little bar chart, or chart underneath that's telling you that this particular day, looking at the percent close from the previous close, was about 1.2%. And I made them whole number percent. So 1.2 on this is 1.2%. That's going to be important in a minute. So I can color the moving averages, color the bars according to the moving average cross. Let's turn that on. So you see here now what I've done is when the fast moving average is above the slow moving average, the bars are blue. It's a very quick way to be able to look and say, okay, uptrend or downtrend. We can also do the same thing to the percent returns at the bottom. And by the way, that is standard finance terminology to talk about returns. You're simply talking about percent changes. Sometimes it confuses people who only come from a technical analysis background. But if we're talking about returns, we're talking about percent changes. So now you can see I have both the returns at the bottom and the price bars themselves colored according to the crossing of these moving averages. And I have chosen, the way I did this morning was I just pulled up some S&P data. And the reason I've chosen to look at this particular time window is it's a period where the market was trending relatively more clearly. And the first thing I would ask you to do, just look at this chart and imagine that I gave you a trading system that said you can only take long trades when the bars are blue. And you can only take short trades when the bars are red. Or perhaps if you're a stock trader and you might say, I don't want to short, then fine. You can only buy stocks when the bars are blue. Does that work? Intuitively looking at this chart, does that work? And I'll tell you, to my eye, I would think so. And the reason is because, we see all of these long trends. We catch most of that. We catch most of this. And yeah, we're flat a little bit, flat to up a little bit. Here's where, here we would have losing trades. But as we know, nothing works all the time. And it would seem to me, intuitively looking at this, that the wins we make in this area and in this area, just visually, and here, that these wins would make up for whatever losing trades we would have on the long side here. And then here we're relatively flat and relatively flat. So it would seem to me we have a winning trend filter. Do we? Well, the first thing let's do, without the trend filter, let's look at the average returns. So that's what we have here. I'm showing you that on that previous screen, there are 257 price bars. They have an average return of 0.06%. Another way to say that is 6 basis points. The average return for all of the bars on that previous chart is, the average return is 6 basis points. Also, 56.5 roughly percent of these bars close up. Let's go back to the chart and see if that makes sense. Okay, it does. And you can, if you compound that, you'll see getting from this level, which is roughly 1700 to 1975 with that kind of average return over that number of bars. The math makes sense. It works. It describes what we see on the chart. We also would think in this time period, more bars close up. So now let's look at something else. What if we take, here's where pay attention. Here's where it gets interesting, finally. Looking at only the blue bars, what's the average return of those blue bars? So that's the second line here. We're talking about 145 bars. And the average return, this is critical. This is very, very important. Going in any day buying the market, we would have had an expectation of making 6 basis points. If you limit your trading to when this uptrend indicator shows, when trend indicator shows an uptrend, your average return is only 1 basis point. Now, that might not seem like a huge difference. That is a 13% loss compounded over the course of a year. It is an extremely significant difference. What if we look at the downtrend bars? We have 112 of those. The average return when we have a downtrend is a fairly staggering 0.19% compared to the unconditional all days 0.06%. Furthermore, on any given day going in over the course of this year, randomly buying the market, we'd had a 56.4% chance of the market closing up. If we only bought stocks when this uptrend indicator said it was okay to buy, then our average close up is we only close up 53.9% of the time. Maybe not a tremendous difference, right? But we're looking at small edges here, and you're clearly on the wrong side of the edge. Also, the downtrend, if we were to only buy stocks when this downtrend indicator says we should be short, you close up 62% of the time. And it's extremely significant. And why? Well, the reason is here's another lesson baked into this. You can't trust your intuition when you look at charts, because we tend to, if we just look at this, for instance, this our nice big winning trade, and we would say, well, we would buy here, we sort of shortcut it to getting out there, and we miss the decline. And we also miss and tend to ignore all of the places where we would have had small losses. And I would encourage you, repeat this yourself. So here's a post from my blog where I dig into this a little bit deeper. I first covered this a couple years ago, and this blog is not so easy to read, but I go through, lay out some of the logic here, and I show you stats for another variation of the trend indicator, the slope of a 50-period moving average, and explain some reasons why. And one of the problems is lag is a huge problem. And also we look at stats here behind a triple moving average indicator. So a lot of different ways to think about this, and that is one of the problems. But if you're using a trend indicator like this, are you only taking long trades when the slope of a moving average is up? Are you only taking long trades when a fast moving average is above a slower moving average? Are you only taking long trades when the moving averages are lined up in the right direction? If you are doing any of those things, particularly in stocks, then you are putting yourself on the wrong side of the market. You are actually trading against a strong statistical tendency. So if you want to do this work yourself, you can do it in Excel. You can do it even by hand. But there are a lot of, and certainly with any type of programming, many software packages will let you do that, will let you explore that. But just ask yourself the question, if you're using this as a tool, if you're using this as a first filter tool, are you helping yourself or are you hurting yourself? So that's it. Like I said, go check out my blog, adamhgrimes.com. If you don't already read my blog, please go there in the upper right-hand corner, type in your email address. I have a mailing list. I hit people a few times a month with some kind of interesting things to keep an eye on and some updates on the blog. So I'd love to be able to keep in touch with you there. Sign up for my mailing list, and also do follow me on Twitter at Adam H. Grimes. If you have any questions, thoughts, criticisms, other ideas, general comments, please comment on this post or drop me an email. I learn a lot from my readers and get lots of new ideas for new directions to think. Thank you very much for your time.